Michele Ferrario. I'm the co-founder and CEO of StashAway. Thanks so much for joining us today and having your lunch if you are in Singapore, Malaysia, Hong Kong, early lunch if you are in Thailand, and I guess breakfast if you are in the UAE with us. Today I'm joined by our Chief Investment Officer, Stephanie. Thank you, Stephanie, for joining as well. And the topic of the day is looking back to Q3 returns, while at the same time looking at market trends and thinking about what to do with your portfolio. Of course, everybody reading newspapers and looking at the news will know that interest rates have started their going down, and that has some effects on how each of us might think about managing your savings and your investments. Now, before I let Stephanie talk about Q3 returns and market trends, maybe allow me to spend a couple of minutes on introducing StashAway for those of you that might not be clients. Thank you, Stephanie. If you can go to the next slide. So very quickly, we are the leading digital wealth manager in the region. We are live in 5 markets: Singapore, Malaysia, Thailand, Hong Kong, and in Dubai. In each of these 5 markets, we're regulated by the local regulators, MAS in Singapore, SFC in Hong Kong, and so forth. We are backed by blue chip investors, including Fidelity, which is one of the largest asset managers in the world, Sequoia, one of the most respected venture capital investors in the world, Hamilton Lane, one of the largest private markets investors in the world, and a few more. I'm not going to go through the accolades we won over time. The company is now 8 years old, so while we operate like a fast-growing company, and we're now a young startup any longer. We've been around for quite a bit of time, and many clients have been actually clients of us for a long time. We work with custodian banks across the 5 regions, so your money is always completely separated by our own assets, and this is by regulation because we are a fund manager. So if you are in Singapore, for example, your money will be either with DBS, Citi, or HSBC, and in Malaysia, similarly, will be either with Citi or HSBC, etc., across all countries. If you can go to the next slide, Stephanie, please. We offer a fairly broad range of product in a curated fashion. So we try to help you guys don't get lost in too many choices, but we all at the same time want to offer enough choices so you can build a complete portfolio with us. We started the company when we launched 7 years ago in Singapore with what in this slide is called core portfolios or general investing, and this is what Stephanie will mostly talk about. The core portfolios is where everyone should have 60, 70, 80% of your money. These are diversified portfolios across asset classes with equities and bonds and real estate and gold, and this is where most of everyone's money should be. We have a few variations on the topic. I'm not going to go into the details, but at a high level, you can either follow the StashAway asset allocation framework. We call it ERA. We have a few portfolios where the asset allocation is managed by BlackRock. We have flexible portfolios where you can build your own asset allocation or tweak our portfolios, as well as we have a income investing proposition that we recently launched in partnership with JP Morgan. We have a strong cash management offering. You see it on the left side of the slides. I'm not going to go through the numbers. Obviously, because this is currency specific, the numbers are slightly different country by country, and the offer is slightly different country by country. But the idea is that with StashAway, you can earn a higher return on your cash than you can if you leave your money in the current account or the saving account at your bank, and that we do it in a very flexible way. We call the suite simple for a reason. It's there is no minimum, no maximum, no lock-in other than for the fixed deposit product. So it makes things easy. We have a thematics offering. Again, you can read yourself. I'm not going to go through the details of that. If you want to, this is for your extra, 10, 20, 30% that is not in core portfolios. And then for accredited investors or professional investors, or more broadly, high net worth individuals, we have an alternatives offers, including private credit, private equity, venture capital, angel investing, and crypto. And for instance, recently we've seen a lot of our high net worth clients, as US dollar cash is starting to pay less interest, we've seen a lot of high net worth clients moving some of their assets to private credit. And we've seen both high net worth and other clients move from some of our cash products to the general investing and the income investing portfolio, because people are preparing for lower interest rates and therefore thinking about how to put their money at work. Stephanie, if you can go to the next slide. So the proposition is on a digital first app, so you can manage everything by yourself on the app. But if you ever have a question, a problem, something that you don't understand, we are extremely easy to reach with outstanding customer support. As you can see in some of these kind of in the screens here, there is a WhatsApp button on each screen. You can click there and we respond in less than an hour. You can call us and we respond in less than 8 seconds, or you can send us an email and we respond in the same day. We're proud that this is kind of while we aim at making sure you never have a question, you never need to talk to us, we want to be there for you whenever you want to talk to someone. And if you are an accredited investor or a high net worth individual, you can also have access to a wealth advisor that will obviously help you think about your overall portfolio, including assets that you might not have with StashAway. And this is part of, it's for free as part of just being a client of StashAway. If you can click to the next slide, Stephanie, this is the last point before I leave you the stage. These are 3 examples of 3 of the general investing portfolios that follow the ERA, economic regime-based asset allocation framework that guides our core product. So this is our really core product. And what you see here is SRI 16, 22, and 36%. SRI stands for StashAway Risk Index. And for those of you that might be more technical, it's in practice 99% VAR. What you can in practice for everyone, the higher the SRI, the higher is the risk. The lowest risk we have available in our general investing portfolio is 6.5%, and the highest risk is the 36% you see here. As you can see, at any level of risk, the exposure by asset class is very diversified. Obviously, as you go higher in risk, you will see more equities. You see 46% US equities, 47% non-US equities in the SRI 36%, and some gold. If you go lower in risk, for instance, looking at the SRI 16%, you see a bit less equities, 20 US and 20 global, and you see a more, broader allocation to gold and bonds, most important, 21% aggregate bonds, 5% corporate, 24% government, okay? From a geography perspective, you also see quite a broad diversification. US tends also always to be the larger part of any portfolio because it's the larger economy in the world and the largest markets in the world. So if you want to have a properly global exposure for your portfolios, you will need to have a significant US exposure. And what you see at the bottom are 2023 full year returns for those 3 portfolios and 2024 year-to-date returns up to the 18th of October, so a few days ago. And as you can see, obviously, both 2023 and 2024 were a strong year so far, but obviously, Stephanie will go deeper on what happened so far in 2024, in Q3 particularly, and then looking forward, what are the expectations. That's it for me. Stephanie, if you want to click forward, maybe before we go next, I want to tell everyone, you can use the Q&A button in Zoom to post any questions, and I will act as the moderator at the end. I will probably have a couple of questions myself for Stephanie, plus, if there is any question for you guys, we will try to address as many as possible. We will try to, be respectful of your lunch break and your lunch time, so we'll try to end on time, but at the same time, trying to address as many questions as we possibly can. Stephanie, over to you.
Yes, thank you so much, Michele, and thanks everybody for spending your precious lunch time with us. Hopefully, this hour will be fruitful for all of you. And of course, if you have further questions after the presentation, all our wealth advisors and client experience representatives will be there to answer any questions. So without further ado, let me go into today's second item on the agenda, which is StashAway's Q3 portfolio returns. Afterwards, we'll spend a bit more time looking at kind of what's ahead, which is even more important as we kind of go through the next few months, which are ending the year. There's always events on the horizon, and we will talk about how to navigate those. So I think, first of all, Q3 portfolio returns. Happy to report that, this year has been generally very, very positive for most asset classes, and including our general investing portfolios. So if you look into this chart, you can see that our portfolios on average in terms of US dollar on the left, have returned about 11%, indeed 11.3% through the first 9 months of 2024. And compared to our benchmark, which has returned 10%, that is an outperformance of 1.3 percentage for the US dollar portfolios. And if you look at the Singapore dollar, in terms of Singapore dollar, Malaysia ringgit, and Thai baht, because the US dollar actually depreciated somewhat versus these currencies, in local currency terms, these portfolios have returned lower than the US dollar returns. However, if you compare with the same risk sort of benchmark average, our portfolio still managed to outperform the benchmark in all the different regions. This is another snapshot of the individual portfolios in terms of the year-to-date performance. Now, as Michele mentioned, the statutory portfolios are ranked in terms of the risk from the lowest risk in 6.5% SRI to the highest risk of 36. And I mean, and not surprisingly, you can see that the higher the risk goes, the higher the return it has been for year to date. For example, if we look at kind of the higher risk portfolios, SRI 36, I mean, that is a 17.3% return in terms of US dollar year to date versus a 6.6% return for the lower risk SRI. However, I mean, of course, when we invest, we always advocate our clients to choose your risk index or risk level according to two things. Number one, your risk appetite, and number two, your time horizon. I think it's interesting to note that I compare with benchmarks. I mean, on average, we have outperformed the benchmarks. In terms of by portfolio, we've actually outperformed our benchmarks mostly on the lower risk side, and I mean, slightly underperforming on the higher risk side. In terms of the absolute attributions year to date, this is the breakdown of how the various, I guess, the asset classes have performed and how have they contributed to the overall portfolios. I think here you can see that the positive contributions are highlighted in green, whereas the negative contributions are highlighted in red. Again, I mean, if you look across all the different asset classes that we include in our general investing portfolios, most of these asset classes are actually in green, with the exception of only one, which is inflation-protected bonds in the SRI 22 portfolio. So all these different asset classes have actually contributed to our positive return on a year-to-date basis. Now, if we kind of zoom into Q3, looking at what's happening in Q3, actually both bonds and equities have had strong returns. I mean, this chart basically shows you 4 lines. The top one in yellow is actually gold. So gold has had a 13% price appreciation during Q3. And I mean, gold has significantly outperformed both equities and bonds. And if you look at the orange line, which is the World Government Bond Index, and the white line, which is equities, actually both have returned in a very, very similar fashion. Now, of course, bonds had much steadier return over time, and equities were a lot choppier. And I mean, this is kind of typical of the differences that you should expect from bonds versus equities. The last line with the red line is actually the ultra short dated US government bonds, and that's sort of the cash equivalent. And in terms of price appreciation, also the cash would have given you 1.25%. That's, I mean, pretty good from a historical perspective, because if you think about analyze, I mean, that's 4 times of 1.25, which is around sort of 5%. However, if you compare that versus bonds and equities and even gold, that's significantly lower returns. And actually, the gold allocation has benefited our ERA portfolios. And if for investors who have been with us for a long time, or at least kind of year to date, you may have remembered that we had a reoptimization done in April. And during that reoptimization, we also made some changes to our structural allocation via our benchmark weights. And I mean, this chart actually shows you the benchmark weights that we use for all our ERA portfolios. So it's slightly different from your usual kind of bond equity mix because we also added gold into our benchmarks. And this is actually the portion colored in green. You can see that, I mean, gold is included in most of our benchmarks in different proportions, but we think that actually including this benchmark would kind of benefit our portfolios in multiple ways, including number one, being a more defensive asset and balancing asset versus the equities allocation. And number two, as you can see, for example, in Q3, that has actually benefited the absolute returns of all our portfolios. This is a very similar chart as the one I've shown before. Again, like breaking down the attributions of different asset classes. Again, Q3 has been mostly positive for most asset classes, perhaps with the exception of U.S. equity, energy equities, which is pretty much flat. And also quite interesting if you look at kind of the bottom of where things are underperforming. I mean, U.S. tech equities have actually also not performed that well. However, I mean, our allocations to gold has actually benefited all our portfolios. And this chart shows you kind of the returns for our different SRI portfolios for third quarter. And in the third quarter, our portfolios have returned on average 6.3%, whereas in the past 12 months, on average, our portfolios have returned close to 20%. We also mentioned thematic portfolios, and this chart shows you the returns of various thematics. As Michele mentioned, within thematics, we have 4 different themes, and for year to date, technology enabler has been the best performer, followed by environment and clean tech, followed by future of consumer tech. Healthcare has been a bit lagging. However, if you look into Q3, actually healthcare has played some catch up. Whereas technology enabler has seen a bit of a stalling, but environmental and clean tech has actually been the best performer in Q3. In terms of other thematics, we also have Singapore investing. So, I mean, Singapore investing in year to date has returned 7.7%. In Q3, it has returned 5.7%. Our DRB portfolios, on average, have had quite a negative return in Q3, and most of that is actually due to the Malaysian ringgit appreciation, which hurt the returns in terms of local currency. We also have BlackRock as part of our general investment suite of options. And here you can see that, I mean, BlackRock portfolios on average have returned 13.3% year to date. In Q3, BlackRock portfolios have returned about 4.7% on average. Lastly, we also introduced the income investing powered by JP Morgan, and you can see that we actually launched a portfolio on 15th of July. So in terms of Q3, it's actually not capturing fully, I mean, the Q3 return. But if you analyze the return that we've had from the launch of the product to end of Q3, the analyzed performance have been exceptionally strong, which stands at 14.5%. Currently, the portfolio yield, I mean, stands at 4.1% per annum. The portfolio duration is about 4.3 years, so not extremely long. We're trying to kind of strike a balance between getting incremental yield versus going too long into the duration. And recently, there was a reoptimization done by JP Morgan. Basically, we have increased our allocation in emerging market bonds, given that we also see better yield opportunities there. So with that, let me wrap up how we've done in Q3. I think in general, statutory portfolios have done decently well in Q3. If you look at ERA, I mean, the allocation to gold has helped our portfolios outperform just a kind of pure stocks or equities portfolio. And also, I think if you look at other portfolios on our platform, they have decently returned in Q3 as well. So, I mean, what's next in Q4, given that we've had a pretty good Q3? Now, I guess it's worth kind of taking a pause and looking at, I mean, what's been, I guess, happening in 2024. Now, this chart is perhaps a bit hard to see, but I guess the point here is to read this chart. Basically, it puts all the different asset classes as different boxes, and equities are mostly in green, bonds are in yellow, and other like private markets and commodities are actually in orange. You can see that some boxes are above the I guess like the years or the year label. Some of them are below. So the boxes that are above the year label are the ones with positive returns, and obviously the ones that are below have negative returns. So if you look at 2024, which is which is where I've highlighted, actually, I mean, year to date, like all the different asset classes that is tracked under this graph have had positive returns. With the highest actually, interestingly, being Chinese equities now, given that it's had a 30% rally in the past month. Chinese equities are now returning 30% year to date, followed by US equities, which is like 22%. And if you look at the lowest ranks, actually, I mean, cash also returned 4.1%, followed by, I guess, the lowest returning asset class has been developed market government debt. Still, I mean, it's positive. So I think year to date, I mean, 2024 has been so far so good for risky assets. And actually, most risky assets have returned higher than cash, despite, I mean, the cash yield still being fairly high from a historical standard. And I mentioned a bit about Chinese equities. This is a chart that shows you kind of how crazy things have been. This is a chart of MSCI China. And if you look at I guess this chart actually started from 2017. The peak was achieved in early 2021. Chinese equities have had a 62% fall since 2021 peak. However, in the past 2 weeks, I mean, Chinese equities have actually played a significant catch-up, and it's up 40% now from its bottom. I guess the lesson here, or kind of the thing that we can take away from here, is that I mean, it seems like the market has gone into I mean, some would say like much more euphoric state, and it's looking for anything that's still undervalued, and even, I mean, China has played catch-up. So, I mean, is there anything left to invest? And if you look at this chart, a lot of us would actually be quite familiar with it. It's basically the global equities index. And if you look at where it is today, of course, equities are trading back at all-time high again. So again, a lot of questions that our investors keep asking us is, I mean, given the rally that we've seen in the last 2 years or so, is it too late? Things, I mean, still going to be rosy going forward. So this is like the key topic that we would like to explore today. So going a bit into kind of how Stashaway thinks about asset allocation or even a kind of the market from a macro perspective, we always refer back to our ERA quadrants. So ERA stands for economic regime asset allocation. It's basically the way we look at asset allocation is based from, I mean, where we think where the model thinks we are in terms of economic regimes. And here, I mean, we have 4 distinct regimes that we can identify. So these 4 regimes are classified in terms of growth and inflation. And if you look at the left-hand side, if you look at left-hand, like top left right corner, we start from good times. This is where kind of growth is positive, inflation is low. So this is a very, very good regime for risky assets like equities. We are currently in the inflationary growth regime, which is a regime where we still have positive growth, but I mean, inflation remains quite high. And then there are 2 other regimes. There's a stagflation regime, which is where we were for a large part of last year and also 2022. And then we also have a recession regime where inflation is low, however, growth is also negative. And I mean, this is kind of the framework we use to think about how different asset classes would perform. So if we think about equities, equities actually have positive returns in most of these quadrants outside of a recession. If you look specifically at the current quadrant that we add, which is inflationary growth, actually excess returns for equities is quite good. So this chart actually shows you the excess return over cash for some parts of for equities, for example, S&P global equities, these would have excess returns of about 7 to 8%. Particularly if you look at industrials equities, I mean, these are actually some of the best times for investing in these cyclical components because they have 10% excess returns over cash. Now, if you look at US long duration treasuries, it's not particularly great quadrant to be kind of long duration because inflation is still a concern. And typically from our historical data, long duration US equities, treasuries actually has a negative excess return over cash. So I guess the lesson here is that, yes, I mean, the equities are at all-time high, but I mean, it is actually a typical reaction when we are in a inflationary growth environment. And the quadrant that we think we should avoid having too much of an equity exposure is actually a recession. So then the next question is, I mean, are we actually going into a recession? Because we can if we can convincingly think about the risk or kind of the risk of being a recession being very low, then I mean we can stay in equities perhaps I mean for the next few months and even longer. So the key question is that, are we heading into a recession? This is a chart that shows you the Google search interest on the word recession itself. As you can see, there was a spike around August. A lot of people were actually concerned about US going into recession back in August because if you look at the unemployment data, it was climbing. And then also there were, I guess if you look at a number of other indicators, they were also softening as well. So back in August, there was a lot of concern about recession. I mean, since then, I mean, a lot of these concerns have actually died down. Most importantly, I mean, the Fed was also concerned. So in the latest Fed meeting, the Fed obviously cut 50 basis points. And the reason or the rationale that they cited was because they are starting to get concerned about unemployment. Before, they were mostly concerned about inflation. So this chart actually shows you the votes or kind of the views of each participant in the FOMC. And if you look at the left-hand side, that's the number of Fed members that are kind of that thinks that unemployment is a concern. And if you look at the progression, I mean, these bars actually represent different times or different FOMC meetings. Earlier on during the year, in March and in June, most of the participants actually thinks that the risk to unemployment is so-called balanced, meaning that they're not too concerned. However, in the latest September meeting, actually many more of them expressed a concern that they think unemployment rate is more likely to increase. On the other side, if you can look at the participants' kind of views on the inflation side of things, back in March and June, a lot of them were thinking that there's upside risk to inflation. However, in the latest meeting, more of them thinks that inflation risk is actually more balanced. So again, I mean, the market and also the Fed was also concerned about a rising risk of a recession. Also, I mentioned data have been a bit weak. So this is the US ISM Manufacturing Index. For those of you who have been following our presentations for several times, we've shown this multiple times. So basically what it tells you is how optimistic or pessimistic are some of these industrial purchasing managers in terms of their view on the US economy. And the dividing line is actually 50. So if this index actually goes above 50, it means that people are more optimistic. If it's below 50, people are quite pessimistic. So again, if we look at this number, it seems like people have been much more pessimistic, particularly starting from this summer. However, we think that actually all these are, I guess, are a bit temporary because of a few uncertainties that are going on in the United States economy. Most predominantly is the U.S. election. We all know that we're just a few weeks till the election in early November. Actually, I guess less than 2 weeks now. But there's still a lot of uncertainty as to who will be in the White House. Now, if you look at the polls and also, I guess, the betting markets, they're basically saying that it's a very, very close to call. And indeed, if we look at the ISM surveys or the PMI surveys, they actually come with some commentaries on how the purchasing managers actually think about things. And a lot of them actually cited the uncertainty due to the US election as a key reason for being not so optimistic in the near term. However, looking beyond the next kind of few months, I mean, they have actually a more optimistic view of the business conditions in the next year. So I think we can be actually a bit more optimistic about things actually turning up to be brighter as we get more clarity from the presidential election, no matter who's going to be in the White House. Because remember, I mean, the market actually hates uncertainty. And once we have certainty, then the market is more likely to move on. Also, unemployment was a major concern back in August. However, September unemployment number has come out stronger than expected. And indeed, if we look at like kind of the subsectors of unemployment, we've seen a broad pickup in the different sectors. It's a very, very busy chart, but basically the green boxes actually shows improvement in that particular subsector, and the red boxes are ones that have deteriorated. So if you look at the bottom, I mean, most subsectors actually saw improvements in terms of employment in September. And I guess more importantly, if you think back kind of 2 slides, what we've examined is the Fed's view on their concern, whether they are concerned about growth or inflation or none of them. It seems like the Fed actually wants to communicate very, very strongly that they will act very, very aggressively should they see more weakness in the economy. So I guess a lot of market participants like to quote the Fed put. Now, the Fed put, what does that mean? It basically means that the Fed will try to prevent an economic slowdown and try to act even before the economy slips into recession. And I mean, obviously, the Fed put was not there in the last 2 years or so because the Fed was actually busy fighting inflation, not preventing growth slowdown. Now, with the last FOMC meeting, what is actually quite important is that the Fed has communicated that this Fed put is now back. So, I mean, equity markets or risky markets actually love the Fed put because you know somebody who has all the gunpowder is actually behind your back. I guess if you look at the FOMC members' own projection of the interest rate path, you can look at the famous dot plot. And this is basically you can see different dots. I mean, these dots are each Fed member's prediction about the interest rate by the end of each year. So by the end of the year, and of course I mean, because every member has a different opinion, so it's very common for us or for the market to look at the median dot. The median dot is actually the light green line. So if you look here, by the end of 2024, the median dot actually sits slightly below 4.5. And by 2025, actually Fed members on average are expecting further rate cuts, about 100 basis points, and 2026 even further rate cuts. So, I mean, the Fed is actually basically signaling that they will continue the rate cut cycle. And if growth numbers deteriorate further, I mean, they would act faster. And then I guess another interesting anecdote to note is, I mean, obviously the Fed cut 50 basis points at the first interest rate cut at the beginning of an interest rate cut cycle. So we've actually gone back and looked at, has this happened before? Yes, indeed. I mean, the Fed has cut 50 basis points or more before, but it's actually the first time that the Fed has done such an interest rate such a aggressive cut outside of a recession or outside of a significant pullback in the equities market. Now, if you look at where S&P year-on-year return has been, I mean, S&P is actually is still up 30% year-on-year when the Fed actually decided to cut 50 basis points. And if we look at historical precedences where, I mean, the Fed has cut more than 50 basis points or more, there's a strong correlation between the future 6 months return of the S&P, I mean, versus where S&P was already at the time of the cut. This is the dots on the right-hand side. I mean, of course, historical analysis could be just it. It may not repeat itself, but I think it's worth noting that the Fed is cutting into a very strong economy and very strong equity market. Lastly, China. So China has been one of the spotlights after a very, very long lull in the last month or so. And the Chinese government has obviously put out a series of monetary policies and trying to stimulate the economy and also bring money back into the Chinese asset markets. Indeed, I mean, we've seen quite a shift in terms of market sentiment and also actual fund flows. So this chart actually shows you the China ETF weekly fund flows, and that's in the yellow bar. If it's positive, it means that people are putting money back into China ETFs. If it's negative, it means that people are taking money out. So you can see that it's been, I mean, choppy, kind of averaging, I guess, pretty low inflows over the past 3 years or so. And in the last few weeks, we've seen a significant pickup in terms of people buying into Chinese equities. So the question is, again, I mean, is China back in business? And I think the series of policies are useful in terms of backstopping a kind of further slowdown in terms of the economy. But if you look at kind of what the problem in China is, looking at this chart actually tells you something quite meaningful. So this chart has 2 lines. The yellow line is China consumer confidence, and the blue line is actually Chinese property prices. So you can see that actually there is some sort of relationship between the two, but in any case, if you look into the last 2 years, China consumer confidence have plummeted, and it's kind of it couldn't recover back to sort of pre-COVID levels. Second thing is, if you look at Chinese property prices, it has been sort of in a free fall, and in recent months is falling actually on a 5% year-on-year basis, annualized basis. So this triggers significant concern with the policymakers, because this actually cause both a low consumer confidence and also falling property prices actually cause a deflationary kind of environment in China, and also the lack of growth. So we think that, I mean, monetary stimulus is good, but the efficacy of monetary stimulus has actually been lower in the past few years. There's a study done by IMF basically showing that it has decreased each time they do a monetary stimulus. And right now, I mean, the market is looking forward to a fiscal stimulus, because fiscal stimulus potentially, if it's done right, has the I guess direct impact of stimulating consumer confidence and also kind of stopping property prices from falling further. So I mean, we kind of await for more policies coming out from China. We think that if I guess given the U.S. election is so close, and I mean, Chinese policymakers, if you just put yourself in their shoes, you would probably wait to see, I mean, who is actually in the White House to come up with the next set of policies. So we mentioned the Fed put, now we've got the China put. So it seems like, yeah, we have kind of central banks and governments on our back. But I mean, there must be a catch, right? There must be something that we need to kind of look out for in the next I guess this quarter. So I think, of course, we mentioned the U.S. election a few times already. So this is kind of I guess the biggest worry that we investors or the market has to climb through. This is a chart that shows you the poll average of Trump versus Harris. The key point here is not who's actually leading by what margin. Because I think actually, if you look at the latest chart, latest update of this chart, it has flipped somewhat. But I mean, I guess the spread between Trump and Harris still remains like too close to call. So we'll find out in very, very shortly. But I think the worst case scenario is that it's not that either Trump or Harris got into office. The worst case is actually that, I mean, we don't get a decisive outcome, and the US kind of election outcome gets dragged on for an extended period of time. However, I would also note that, I mean, politically induced volatility tends to be quite short term. This is a chart of the S&P index back in 2016. And I mean, it's just actually a short few years ago, but a lot of us remember it was a very, very volatile year. So you can see that there were two significant market corrections that year. First one during June and the second one during November. So the November one was when Trump got elected for the first time. And I mean, the market was actually very, very nervous because Trump was going to put out all these trade policies, and the market reacted quite negatively. However, you can see that, I mean, basically the market started recovering very, very soon because they figured actually, I mean, Trump would also, I mean, Trump, yes, I mean, he would introduce all these trade policies, but also there would be tax cuts introduced to US companies, would ultimately benefits corporate earnings. And so the market actually just climbed afterwards. And also, if you look at the economic fundamental during that time, I mean, the economy was actually quite strong. So again, I would say that I mean, despite who's in office, I mean, it basically comes down to economic fundamentals, like the four-era quadrants that we talked about. That sort of is the bigger driver of longer-term returns, rather than these short-term induced volatilities. And oftentimes, I mean, these are good opportunities to add more to your longer-term portfolios. So if, I mean, we're still quite uncertain about the most important election in the world, like how do we stay invested in this kind of environment? I mean, the answer is to be globally diversified. And I mean, that's why at Stashaway we provided different risk points that are basically portfolios of the different asset classes that you can invest, including equities, bonds, gold, and cash, and also within equities. I mean, you can diversify across geographies and also sectors. So as you can see, I mean, I won't go into details here, but I mean, there are the reason why we include all these different asset classes is that basically, if you think about risky assets, I mean, they are much more volatile than safe haven assets. But the safe haven assets like gold, for example, or even just, I mean, government bonds, short-dated government bonds, I mean, these actually provide the cushion that you need if there is volatility. And it gives you kind of, number one, a peace of mind. Number two, perhaps a bit kind of more willingness or ammo to actually add more to your longer term portfolios. So again, volatility is nothing new to us. I mean, we've all gone through different cycles, and even though the course of each cycle is different, basically, I guess there are a few things that remain the same. Number one is that, I mean, long-term asset classes actually have positive returns ultimately. So whenever you have drawdowns, I mean, it will recover. It's just a matter of like how quickly it'll recover. And also number two, can you actually stay invested during that pretty stressful period? So this is a chart that shows you Stashaway portfolio returns or performance since January 2022. Now, of course, since 2022, we've gone through quite a tough period in terms of markets. We had a significant drawdown in 2022. Stashaway portfolios are all long-only portfolios. So when asset classes actually go down, portfolio returns will be negative as well. But I think what's important is if you compare Stashaway portfolios, which is the solid blue line, versus our benchmarks, which are the dotted lines, During drawdowns, we had actually had less drawdowns than our benchmarks. And also, I mean, in the upturn, we're able to capture most of the upside as well. So I mean, net, I guess it helps to cushion all these uncertainty, all these drawdowns. At the same time, it ensures that you enjoy the longer term positive returns from staying invested. So since 2022, our cumulative outperformance versus our benchmarks have been on average 6.7 percentage points. So lastly, I'll just, I guess, show everyone to Investor Truth, because that's, we get a lot of questions about these. Number one question is already all-time high. Is it too late? Now, I mean, if you look at this chart, I think it's worth a refresher into how stocks have performed. So this chart actually shows you the S&P index. You can pull up similar charts for global equities as well. Now, if you think about all-time highs, so I've drew kind of four, I guess, up arrows. And these are all periods when you have all-time highs. So the first period, if you start from the left, the red arrow, I mean, that started kind of mid-2016. I guess that was when, like, during the presidential election cycle 2 cycles ago. And I mean, it's from kind of mid-2016 onwards, you can, most of the time, you would be investing at all-time highs. However, it doesn't mean that you won't get extra returns, or you won't get returns above that all-time high. Of course, like the later you get into the game, I mean, the more likely that you're gonna see, I guess, shorter term fluctuations as you get into 2018. But I mean, just the fact that you're at all-time high does not mean that you can't get positive returns. I mean, same thing goes for 2019, 2020 to 2021, and now, I mean, we're looking at 2024. So, I mean, all-time highs actually happen quite often in equity markets. That's because companies actually continue to earn earnings growth. And when you buy into an equity market, basically you buy into the earnings growth of the collective company. So I think I mean, being an all-time high doesn't mean that these companies would stop trying to make profits, because I mean, companies actually need to survive, and they exist. Most of them exist for the benefit of the shareholders. The second thing is, if you look at these kind of, I guess, all-time high periods, today, if you kind of zoom into 2024, so I mean, equity market S&P is up 23% from its last all-time high, which is in 2022. Now, how does that compare with kind of these historical episodes of all-time highs? So the last time the S&P surpassed the 2020 pre-COVID all-time high, the rally lasted about like kind of I guess a year and a half, and the return was 43%. And then the previous time it was 17%. The previous time it was like 34%. So I guess 23% is, yes, it's higher than the rally that we've seen in 2019, but it's still lower than what we've seen during 2021 and also in 2017.
Can I add something? Can I point out something, Stephanie, as well? So I think in this chart, there is one more thing that comes up to me, which is that, for instance, if I use the example on the red example on the left side, the first example, it's true that it was a all-time high from mid to 2016 until in practice late 2017, early 2018. But not only these were all-time high, but in practice, there was never a moment in the future where the markets were cheaper than these all-time highs. So they were all-time high, but then the market never went cheaper than this. Maybe with the exception for some of the latest all-time high from the March 2020 very quick correction that lasted only a month or two.
Yeah, and it's very short, right? Very short.
So all-time highs can also, yes, it always seems a bit scary to get in the markets, etc. But because you don't know the future, if you have a long time horizon, might actually be the cheapest point to get into the market. I mean, we don't know for sure, but if you look historically, it's often the case. And this is true of, if you look at the third period as well. Again, March 2020 may be an exception because the correction was particularly strong. I mean, if you remember, the world stopped in practice with COVID. Hopefully it doesn't happen again from a world perspective. But if you look at also what happened between 2020 and 2021, similarly, all these all-time highs have also been good entry points. And even if you enter at the all-time high, like the final all-time high in late 2021, today it will still be 2 years later, it will be 24% up, right? So, which is actually in 2 years, even if you enter the worst possible time.
Yes, correct. So, I mean, again, there's no way to go back in time. So you can't get the prices that you got like 2-3 years ago. And but it's never too late to start investing, because if you think about kind of forward, most of us still have multiple decades of investing potential ahead of us. So that brings us to the second slide. Again, even if you bought at all-time high, it doesn't mean it's the end of the world. This is a chart that shows you the S&P index all the way back to 2003, so 20 years of S&P. And I guess the one all-time high that a lot of people got very, very scared was in 2007, right at the beginning of the great financial crisis. So of course, if you bought at all-time high back then, you would have experienced a 50% drawdown in the S&P index. However, it doesn't mean it's the end of the world. Like, if you can sit it out, I mean, still to today, you would have enjoyed almost 3 times returns from buying from that all-time high. And that's equivalent to a 8.2% annualized return. And this is not including dividends, actually. So if you include dividends of 2%, I mean, that's basically a 10% return on investments per year, which is, I mean, not bad at all. So I think, I mean, this actually is a good reminder to us that the risk is not that you buy at the all-time high. The risk is that you wait for your all-time high and you never get into the market. So maybe I'll stop it here.
Thank you, Stephanie. And maybe before I start with questions, and I have a couple of my questions, plus there is a few questions on the Q&A function in Zoom. I just realized that I did not. So we have a bunch of people on YouTube as well, and I didn't mention how to ask question there. There is a chat box on YouTube that you can use to ask question. If you don't see the chat box on the screen, you need to scroll down, and there is an option below the video called Open Panel, which will allow you to see the chat box. If you write your questions there, my colleagues will actually make sure that I see these questions, and Stephanie can address them. And especially you're still sharing your screen, so you might want to still be where you are. Yeah. So first question is kind of for me. I think you kind of wrap it up already, but you said a bunch of things about the fact that broadly there is a positive, a lot of positive news. Inflation is going down. The Fed put, the China put. Employment being strong, so a lot of good positive news, but at the same time markets are well priced, and we are in an all-time high. And so you kind of address it just a second ago, but I want to go back to that for a second. How do you think about someone that has maybe stayed with a lot of cash over the last year and a half, because they were happy with 5% returns on US dollar cash, or 3.5% or 4% on Singapore dollars cash, but at the same time you see 2023 as equity returns as our higher risk portfolio 18%, year to date 17%. So if you were all cash, you left a lot of money on the table. How do you think looking forward? Should I stay cash? Should I wait? I'm worried, it is true that the markets are well priced, and so you never know what happens tomorrow, the next week, and next month, and we don't know, right? We can only think about what the options are. But how do you think about that as an investor?
Yeah, I mean, that's a question we get a lot, right? Given that the cash yield is still fairly high, and cash is riskless, so you actually don't lose any sleep over the cash that you hold with us. But I think if we go back to the era regimes, basically, this is not a bad regime for taking more risky assets. And if you look at the Q3, I guess, returns that we show, in Q3, for example, sure, I mean, staying in cash would actually give you 1.25% returns in a very, very stable manner. However, you've lost out to all these other asset classes that will give you higher returns. So a lot of us are concerned about, oh, if I put in, like, if I invest today, am I going to catch the top of market? Or if there's a correction, would I able to take advantage of it if I invest today? So I think there are a few tools or kind of tricks that we can help to mitigate this concern. Number one is that I think if you are planning to, if you still have a lot of cash and you're planning to deploy that chunk of cash, I mean, you don't need to do everything at once. You don't need to put all your eggs into the basket today. You can, a very good technique is actually to chunk it up. So for example, if you divide it into, let's say 2 portions or even 3 portions, you invest 1 portion today. And for the second portion, I mean, either kind of set yourself a timeline, let's say every 3 months, or you set yourself a kind of a correction kind of criteria to invest the rest of it. That way, I mean, today, let's say you invest 50%. Let's say the market actually goes up another few percentage points in 3 months' time, because you already have invested, then you would enjoy that upside. And let's say if the market goes down because of election or whatever reason, then I mean, you're also still quite happy because you still have the rest that you are waiting to deploy. So I think at the end of the day, I mean, investing is about how do you ensure that you don't regret certain decisions that you make. And so chunk it up, make sure that you don't regret like the initial investment decision that you made. Now, the second tool, which is a tool that I mean, I think StashAway has made very, very easy and straightforward, is to do dollar cost averaging. So, I mean, if you're concerned about putting everything in today when the market is high, a very good tool is to set up a recurring deposit into whatever risky, I guess, StashAway portfolios that you have. It can be kind of a monthly basis or even kind of weekly or even more frequent. But I guess the goal or the aim of that is to make sure that you get invested over time. So I think that's another very good tool to utilize on the StashAway platform.
And maybe if I can add one thing, you can actually, on the StashAway platform, you can put money in Simple. If you're in a country where we have StashAway Simple, or in US dollar cash, and in US dollar cash, you can actually set up recurring investments. So you can have a simple portfolio and your general investing portfolio and say, look, I want to transfer $1,000 every 2 months from my simple portfolio to my general investing, or from US dollar cash to general investing. That's a good way to just automate your dollar cost averages, so you're not going to be misguided by your own emotional reactions to titles you read on the newspapers. Linked to this, there is a question, Stephanie, from one of the attendees anonymously, asking, the S&P is now trading at a P of more than 20 versus historical of 15 or slightly higher than that, I would add. Will it continue to outperform, or do I need to reduce my risk, so reduce my SRI? So I guess the way I want to phrase this question is, how do you think about risk in the market as an investor, and does it change given where we are in terms of pricing of the markets?
Yeah, so I think so there's, I think, 2 questions here. Let's unpack it. The first question is, would S&P continue to outperform given it seems to be quite expensive? The second question is that how should you think about your SRI levels? So let me answer maybe the second question about how do you think about SRI first. So the way we've designed the StashAway Risk Index is basically a risk metric, because the number actually measures or gives you an estimate of the worst case scenario. So let's say, for example, if you choose a SRI 36, I mean, that is the highest risk portfolio. In a worst case scenario, there's a 1% chance that it will fall by 36%. Now, if you feel like that is either, number one, too much risk, you would lose sleep over that temporary drawdown. Or secondly, your time horizon is actually quite short. Let's say you need some cash for the next 2 years. That may be too high risk. And then you can start to adjust your risk lower, right? So for example, if you think about different SRIs, a lot of our investors actually like the medium risk profiles, which are, for example, 22 or 20. This actually portfolio would give you kind of much better protection in case there's a market drawdown. So this SRI actually is what we so-called a strategic asset allocation framework. So it doesn't change according to the economic cycle, because StashAway would manage the cycle such that even if you're in a recession, I mean, your SRI number actually doesn't change. So it wouldn't, like, your portfolios actually would not get riskier with the change in regime. So I think the way to think about SRI is to ask yourself two questions. Number one, can you sleep at night? Number two, how long is that time horizon for the money that you're investing in? Second question about S&P. Yes, today is actually quite expensive, and a lot of us, if you look at kind of the PE ratios, would think that actually S&P is at on the more on the richer side. I think there's a few things I would like to point to. Number one is that if we look at the relationship of the S&P price to earnings multiple range versus the Fed's balance sheet, it has a strong correlation, meaning that as the Fed has expanded its balance sheet since the great financial crisis, the price to earnings ratio for S&P has actually climbed a lot. And unless, I mean, the Fed shrinks the balance sheet significantly, I mean, I guess the historical range of the PE ratio has actually gone up. So even if you compare just the full range of historical PE versus where we are right now, it may not be a fair comparison, because before the financial crisis, we did not have a Fed that has such an expanded balance sheet. I think the second thing to note is that if we look forward, the U.S. government is going to spend a lot of is going to issue a lot of bonds to finance its fiscal package. So if you look at the election platform for both Trump and Harris, they have a lot of things that are different, but one thing in common is that both governments, no matter who's in office, is going to spend a lot in terms of government-funded activities. And that's going to boost the GDP for the U.S. economy. But at the same time, the government may need to issue more debt. And who's going to buy it? Probably the Fed again. So I think it's very unlikely that the Fed will actually shrink the balance sheet significantly. Hence, there is some limitation, or we should take a grain of salt when we simply look at the historical range of PE metrics.
Thank you, Stephanie. Timo is asking, what is the driver for the outperformance of the lower risk SRI portfolios and for the underperformance of the higher risk SRI portfolios? And I'm going to combine this question with somebody else asking, you've mentioned about benchmarks several times. What are those benchmarks? So given that the two are kind of ahead.
Yes. So why don't let me answer the benchmark question first, because I think that sets the stage. So benchmarks are basically how we think the neutral allocation is from a much longer term perspective. Because within a benchmark, for example, we have four major asset classes. This is equities, bonds, gold, and ultra short bonds, which are basically cash equivalents. So, you can have different benchmarks. Most funds actually only have equities and bonds as benchmarks. One very, very common benchmark is a 60-40, meaning that it's 60% equities, 40% bonds. And the reason why we need to have these benchmarks is that, they give our investors, such as yourself, a clear idea of, what to expect in a portfolio. So we can't just go into a portfolio one day and say, oh, we want to be 100% equity for the SRI 16, because it deviates too much from our structural benchmark. And the way ERA works, the way ERA kind of adjusts our portfolios is by deviation versus the benchmarks. And the deviations are actually also limited. So, within the ERA framework, we limit our deviation versus benchmarks, but there's tilts to these allocations according to the regime. So, for example, in a inflationary growth regime, we have tilted lower our allocation to government bonds versus what these benchmarks would have mandated. So over time, if you kind of look across cycles, the benchmarks are actually the neutral weights. And then during the different cycles, then we tilt these allocations slightly above or below the benchmarks. So that's how benchmark works. Now, I think the other question is basically about our performance versus these benchmarks. So if I go back here to the, year-to-date returns in terms of our returns versus benchmarks, you can see that in the high risk benchmarks, yes, we have slightly underperformed our benchmarks. But there's a slight difference between non-US dollar portfolios, US dollar portfolios. So a significant part of that relative underperformance was due to our, I guess, slight over allocation to international equities in the beginning of the year. I mean, as we all remember, US equities was quite strong. And that was partly due to our I guess, view that US dollar would be quite neutral, and therefore we had to take a bit more risk in the international markets. I guess if you look at the lower risk benchmarks or lower risk relative performance, this is where we have significantly outperformed our benchmarks. So, for example, if you look at SRI 6.5, we've actually outperformed by 4.5 percentage terms in US dollars and 5% in non-US dollar portfolios. And this is predominantly due to our overweight in gold and underweight in bonds, because the ERA, I guess the ERA quadrant actually signals that this is the tilt that we should take versus our benchmark. And if you, I guess, yeah, one thing is to remember that our benchmark has these different inclusions of gold, equities, and bonds. So even though compared to benchmarks, I mean, we slightly underperform. I think if you compare to, I mean, just equities and bonds, we actually were outperforming in Q3.
Thank you, Stephanie. We have way more questions that we can go through. So in the interest of time, let me ask you one last question. And apologies for people that have asked questions that I couldn't get to. Jonathan is on YouTube is asking, we see headlines from Citi or Goldman saying that S&P growth may be limited in the coming year. If so, what could a StashAway investor do to adjust portfolio to protect from downward fluctuations?
Yes. So thanks, Jonathan, for this remark. Yes, I know the I guess if I look at the research pieces that came out from Goldman or Citi, basically they're saying that US equities from this current valuations have limited upside in the next 10 years. Now, again, I would point to the fact that, I mean, we mentioned actually looking at historical PE may not be a completely fair comparison, given that the Fed's balance sheet is a lot bigger than it used to be. And then secondly, I would just point out to, I mean, this chart here in terms of the final kind of long-term return that we show for the S&P. And when the S&P has made all-time highs, a lot of times they were trading actually at higher valuations. And this is because the market is giving much more premium to the fact that a recession risk is low. So unless there's a recession coming, it's, I guess, the risk of a valuation compression in a very significant manner is rather low. So, I mean, this, I think, as long as earnings growth keep delivering sort of 10%, around 10%, then it's reasonable to expect that you should get around 10% annualized return from being invested in the S&P or the stock market. And if you look at the recent quarterly numbers that are coming out, because the US is going through its quarterly earnings season right now, I think it's pretty much on track to deliver that sort of 9 to 10% earnings growth that we expect. So again, it comes back down to earnings delivery. I think valuations would fluctuate, but when valuations actually fluctuate, it gives you good entry points into these longer-term earnings trends.
And maybe if I can add one thing as we close, Stephanie, if you know, in part of the research that is coming out, it puts a lot of emphasis on the fact that returns over the last couple of years has been driven by a handful of companies, the Magnificent Seven, and obviously there are ways to diversify your portfolio. For instance, in the last reoptimization, our asset allocation framework did actually add into the universe the ability to invest in S&P 500 equal weighted rather than market weighted, which actually takes away some of these issues. I don't know if Stephanie want to say a couple of words on this, and then we can maybe close the call.
Yes, correct. So as Michele correctly pointed out, in the last 12 months, most of the earnings growth have been concentrated in the large cap tech stocks that are related to AI. But that is about to change. So if we look at the forward earnings growth estimates for the broader companies, the mid caps or even the small caps are starting to play catch up. So next year, for example, we see a much kind of more even earnings growth picture for the S&P overall. So I think that actually paints a pretty good picture for the rest of the market outside of this Max 7. And as Michele mentioned, we have for example, allocate some allocations into the equal weighted S&P, which is starting to again make all-time highs in terms of its recent price action. So again, that speaks to the broadening out of a bull market, and typically these broadening outs are actually pretty good for I guess for forward returns.
Perfect. Look, Stephanie, thank you so much for your time. Thanks so much for everybody that joined the webinar, and thanks a lot to also all of our colleagues that are kind of in the back helping out, answering some of the questions and helping with the logistics. I wish everyone a great afternoon, and thanks a lot again for sharing your lunch with us today. Thank you.
Thank you, Michele. Thanks so much.
Thanks.
Bye.